Welcome to Lecture 5, Part B of Financial Statement Analysis. This section of the lecture is a very brief section of revision on reformatting the financial statements. The reason why I wanted to do a little bit of revision on reformatting the financial statements before we actually get into our ratio analysis is that in the ratios we calculate today, we're going to be using a lot of terminology which is based on last week's work on reformatting the financial statements. So to make sure you understand the terminology I'm using, I wanted to briefly go over what the reformatted statements look like and the information they present. This is the part of financial statement analysis where there is a lot of new information presented that you haven't seen in previous subjects. There is a lot of new terminology, and it's a stage of the subject where some students do start to get lost as I start using a lot of new terms, new ratios, and they may not understand what I'm talking about. So this little bit of revision here is aimed to help you make sure that you keep up to track with the terminology that I'm going to be using in future weeks. This slide's straight from last week's lecture. It's the steps in reformatting the financial statements. And we can see the first step in reformatting the financial statements, we want to look at our statement of changes in equity. We want to be able to figure out what the firm's comprehensive income for the year was. We want to be able to calculate the payments that the firm has made to the shareholders, that is D, net payments to shareholders, and we adjust for any changes in ownership interests or outside equity interests. Okay, and we can understand the way that accounting, the balance sheet changes from one year to the next, our owner's equity at the start of the year, plus any comprehensive income, minus any payments we've made to shareholders, plus any change in ownership interests equals the equity. Once we've got that, we then split the balance sheet into operating and financing activities. So the key thing to remember in reformatting the financial statements, operating activities are the things that your business does in its normal course of operations, buying and selling inventory, paying employees, paying taxes. These are all operating activities. Financing activities are things that have interest associated with them. So when you receive funds from a creditor like a bank, or if you sell bonds and you have to pay interest on them, they are financing activities. So financing is about how you have financed your business's operations, and all the other activities are classified as operating activities. So for the balance sheet, we look at every account on our balance sheet in the assets and liabilities, and we classify if that account is likely to be an operating activity or a financing activity. If there's interest associated with that account, it's a financing activity. If not, we classify it as an operating activity. In the end, we end up with NOA. This stands for net operating assets. That is our operating assets minus our operating liabilities. Then we have NFO, net financial obligations. This one will be our financial obligations, so any borrowings or bonds payable minus any financial assets. And that equals equity. And that equity number is going to be the same as the non-reformatted financial statement. Assets minus liabilities equals owner's equity. Net operating assets minus financial liabilities equals owner's equity. The accounting equation still balances. All we've done is split the operating and financing sections apart. Next, we split the profit and loss statement into operating and financing activities, and we calculate NOPAT, net operating profit after tax, NOPAT. That takes into account our operating profits, so operating revenues minus any operating expenses. Again, these are the normal day-to-day kind of operations. You're buying and selling goods or providing services. You're paying your employees' wages. You're paying the inventory, manufacturing cost. All those kind of things go into your operating profit. Then we minus off any net financial expense after tax. The net financial expense, in very simple terms, it's kind of getting at your interest payments. So have you got any interest expenses and interest revenues? You net them off to calculate your net financial expense. We then take into account the tax shield and calculate net financial expense after tax. Operating profits minus financing costs equals our net profit. Net income plus any other comprehensive income is going to equal our comprehensive income. And finally, instead of reformatting a cash flow statement, we can do some calculations to calculate our free cash flow. We've got two formulas. They give you the same answer. The first one is based on the operations of the business. NOPAT, so our operating profits, minus change in net operating assets, plus any other comprehensive income, gives you our free cash flow from operations. Okay, we've earned some profits. We can either put those profits into buying more assets, that will show up as a change in net operating asset. If we don't, it's free cash flow that we'll be using to pay back our shareholders and credit holders. Another way of looking at free cash flow equals net financial expense after tax. It's kind of like the interest we're paying minus change in net financial obligations. Have we borrowed money or have we paid back our loans? So any interest we owe minus any changes in our borrowings if we've borrowed or paid back our loans, plus any payments to shareholders, minus any. So free cash flow from our financing activities. Free cash flow can be used to either pay back our debt holders, the interest we've paid and changes in how much we've borrowed, or free cash flow can be used to pay back shareholders. So we look at the changes in payments to shareholders. So they're the two free cash flow formulas. What do the reformatted statements look like when we've actually done the reformatting? This is a reformatted balance sheet. All our operating assets, accounts receivable, inventory, prepayments, they all go into the operating assets, and you calculate your operating assets. Then the operating liabilities, accounts payable, wages payable, all those kind of things that are part of our operations are operating liabilities. Operating assets minus operating liabilities equals NOA. Then we go down to the financing section. Here's our financing section. We've got marketable securities, which are a financing asset. We've got bonds payable, which are a financing liability. And because most companies have financing liabilities, I'm calling it net financial obligations or net financial liabilities, either term's fine. And we take the bonds payable and I've minused off the financing asset to get the net financial obligation. The owner's equity still balances out. My NOA minus NFO gives me the book value of equity. Same as saying assets minus liabilities equals. Reformatting the profit and loss statement. When you actually do the reformatting, you start with the financing section here. We've got some interest expenses and interest revenues. We take into account the tax shelter, 30%, which is the Australian company tax rate, multiplied by the net financial expense, gives us a tax shield or a tax shelter. The net financial expense, minusing off the tax shelter, gives us the net financing expense, NFEAT, net financial expense after tax. Essentially it's saying how much money have you paid in interest on the loans that you've got. That's an easier way to think about it. And it's the interest after you get to make the tax deduction. So that's our NFEAT. Then we go up to the operating sections. We've got our operating revenues minus any operating expenses. Then the tax expense that's given to us, we have to adjust for the tax shield that we've calculated here. And we calculate a tax on operations, which is the given tax expense plus the tax shield. Operating revenues minus operating expenses minus the tax on operations gives you NOPAT, net operating profit after tax. NOPAT minus the net financial expense after tax gives you net income or net profit. Then if you've got other comprehensive income, you adjust for that to get your total comprehensive income. So the key terms. These are the things that I'm going to be using, the terms that I'm going to be using when we learn the ratios. We're going to be using the terms NOA, net operating assets, and NFO, net financial obligations. These are both from the reformatted balance sheet. We're going to have ratios that use these when we're analyzing the operating performance of the business. We're going to use NOPAT and NFEAT. NOPAT's the net operating profit after tax, straight from the reformatted income statement. And NFEAT is net financial expense after tax, straight from the reformatted income statement. All these terms here, I'm going to be using them in each of the weeks. Our valuation models are going to use some of these terms. Our ratios are going to use some of these terms. So although they are new and it does take a little bit of time to remember them, make sure you can either keep this slide nearby when you're doing your ratios and formatting, or just start to practice and remember where all these different terms come from and which statements you need to get the information from.